Hi, everybody. Good afternoon. We're going to get started. I know there's still people logging on, and let me just mute one thing real quick. But I know it's interesting times, to say the least, that we're living in right now, and lots of information coming out on obviously a lot of different things. But what I wanted to focus in on today, where I believe that there's some pretty good opportunities, especially from a tax perspective, is the new CARES Act and part of the stimulus package and how it relates to individuals. So that'll be the focus today. We're not going to get into stimulus checks, although if anyone has any follow-up questions on that, feel free to contact me. Happy to go through that information. We're also not going to talk about business planning. We will probably have a follow-up webinar just specifically on businesses, because this CARES Act and this stimulus package, I mean, it's so lengthy. There's so much information. We could really have, probably a full webinar or, a full class on each of these areas. But today, specifically going to focus in on individuals and their retirement planning. Some of the topics we'll go through just in the beginning, I at least want to touch on and at least throw out there because I think, it might apply to many of you, might not be, substantial benefit, really with regard to some of the above the line deductions on charitable deductions and things like that. But want to make sure we address it. And then from there, we'll get into some other topics that will tie into some of the tax planning strategies where I feel like there's some good value add. So let me do this. Let me share my screen real quick. And also want to point out as I do this that at the bottom, or depending on exactly how your Zoom program's working, wherever the menu is, there's a chat feature. So at any point during this, I am going to save questions for the end, but I will carve out some time to where I'll make sure that we address as many questions as we can. But at any point, if you want to click that chat button and then type it in, it could be a question just to me. You could also make a question to everyone. But at the end, like I said, I'll try to get to as many questions as I can. But feel free to type them in at any point, because if you're like me, if something crosses your mind, you want to get it down, just make sure to use that chat feature. So let's get into it. So we do have an hour today, which seems like a good amount of time, but it still will be a general overview. But I do want to make sure that you get value from this and dig into some strategies. I know there's some clients of the firm on the call today, but then also some new people. So for those of you that are clients of Canter Wealth, welcome. Your advisor, or if it's myself, obviously we'll get into a lot of these topics and how they apply to you. But of course, if you have any follow-up questions, feel free to contact your advisor. And for those of you that are new, my name is Michael Bernier. I'm with Canter Wealth. I'm a certified financial planner. And before we jump into it, just give you a little background on myself. My main focus is those that are in retirement or near retirement, and really focusing on the tax efficiency in retirement planning. Specifically with regard to how to most tax efficiently produce retirement income. We go through our whole life and we build up assets, which is a different ball game than then drawing from your investment assets and really making sure you have a good understanding of how those assets are taxed. So with some of the topics that we'll go through today, one of the things that I'm going to get into that's going to hopefully tie it all together and really give you some strategies that you can look at and implement soon. That will hopefully give you a lot of guidance as I bring it all together towards the end. But we'll get into the CARES Act and your retirement, coronavirus-related distributions. That's a really interesting topic. And as I say it out loud, I guess it might not be interesting to everyone, but there's actually some unique opportunities when it comes to coronavirus-related distributions. And then we'll just get into the CARES Act in general and some tax revisions, and then also enhancements to employee loans. So that's actually where we'll start. We're not going to spend a lot of time here, but as the CARES Act applies to individuals, I do think it's important to point this out because obviously there are people that are struggling. A lot of people have been laid off or furloughed, and so they might need access to additional funds. So a couple topics that I at least wanted to touch on were enhancements to loans from employer plans. So prior to the CARES Act, we were limited to either 50% of our retirement plan through work or $50,000, whichever is higher. They did increase that. So now the max loan amount has increased from $50,000 to $100,000. and it could also be 100% of the vested balance. So what that means is, under the old rules, like I said, it was $50,000 or 50% of the account, whichever was higher. So let's assume that you had a $60,000 retirement plan. You would max out at $30,000, right? 50% of the account value, not necessarily the full $50,000. But now it is $100,000, and if your account was $100,000, you could fully utilize that vested balance. Another key feature is that you do or you can defer those payments up to a year. So if you were to take a distribution today, April 28th, 2020, normally you would shortly thereafter start your repayment plan into your 401k or other employer plans, but those now can be deferred by up to a year. So that's helpful, right? I mean, for those that do need to get access to additional dollars, it's not ideal. I mean, I guess there's so many different situations, but it's not ideal to necessarily tap into your retirement plans earlier than you expected. But if a loan makes sense, and if you do need access to those dollars, at least there's some additional flexibility there. So then one other note that I wanted to touch on, like I said, was with regard to qualified charitable contributions. It's not a huge benefit, but I think whether we're going through times like these or not, any additional benefit's great. So it's an above the line deduction. So I'm actually going to start with the last two bullet points there, that this is only available for those who do not itemize. Now, over the last couple of years, with the changes in tax law, a lot more people are just taking the standard deduction. So if you are taking the standard deduction, unfortunately, unless you made a really large gift, you are not eligible to actually write off any charitable contributions because you're taking the standard deduction. So this applies to people that do not itemize, who do not normally get to take advantage of a charitable contribution. Now, it is limited to $300, right? So it's not a giant benefit. It does need to be made in cash. So this wouldn't be, charitable gifting, giving things to Goodwill or, other organizations in terms of stuff. So it does need to be cash, and it does need to go directly to a charity, a 501c3 charity. If you have, or if you've heard of, or if you have a donor advised fund where you get the deduction, but you control how you gift that over time, that doesn't apply, and it can't be a supporting organization. So, if you assume just a easy math between federal and state, if you're in one of the highest brackets and you're paying 50% as your marginal tax rate, this would be a benefit of $150. So not substantial, but every little bit helps. So we do have this additional above the line deduction. Also, just with regard to those that do itemize, they have increased, normally they've increased the limit on how much is actually deductible in a year. Normally, depending on whether it's cash or things or stuff that we've donated, we've been limited based on our adjusted gross income. So, most recently it's 60% of adjusted gross income. Anything above that, you don't lose. You get to carry forward to following years if you do make a large charitable contribution where you go over those limits. But now that has been increased to 100% of adjusted gross income. So you can basically, again, I mean, you have to give dollars away. So you don't give dollars away just to give them away. But if you're passionate about a certain charity or charities or church, and this is a year where you want to take advantage of that and you would normally gift anyway, this might be a good year to be able to fully maximize that and wipe out any income or up to any amount of your income for 2020. So that has increased to 100% of AGI now. Again, has to go to a 501c3 charity, can't be a donor advised fund, can't be a supporting organization. So just wanted to note that as well there. All right, so I want to get into coronavirus related distributions. And this is an interesting area where, it opens up some planning opportunities. I believe that probably most of us in some way, not all of us, have been affected by, the current situation, especially if you're working, right, and being, either laid off, of course, furloughed, or just not being able to work the same amount of hours or to be able to, bring in the same level of income based on, the stay-at-home orders, might, like I said, open up some opportunities. So what it is the coronavirus related distribution. It can be up to $100,000. So this isn't a loan. It's a similar dollar amount to what we were talking about with employer plan loans, but you can take a distribution in 2020 Now, what's interesting about this is it can be anywhere from January 1st. So before we were really dealing with, the extent of what we're dealing with right now, but anywhere from January 1st of 2020 all the way until December 31st of 2020, regardless of age, you can take a $100,000 distribution from either your employer plan or from an IRA or a combination of those. So it has to be made in 2020. In terms of qualifying, this is where we start getting into the qualifications. If you're diagnosed with COVID or one of your family members is diagnosed with COVID-19, well, then that would definitely qualify you. Number two, I would say probably opens up this area for quite a few individuals, but any financial burden as a result of being quarantined, laid off, or having work hours reduced. Number three, unable to work, because of the lack of childcare. And then own a business that has been affected. And number six is interesting. The way that it's written is meet some other reason that the IRS decides is okay. What we're reading, and new information is constantly coming out, is that the way that they had worded it in the CARES Act is a pretty lenient, flexible way of wording it. I don't think anyone should, come up with a story that's inappropriate or not true. But I think if you actually read through the code, and at least the way that I'm reading it, it's pretty flexible. And so if you do have a legitimate reason, I would venture to say, even if, I'm drawing income from my retirement portfolio, and because of the way that the stock market's been affected through all of this, that is having an effect on individuals. So I do think it's a very flexible definition to where if you wanted to, you really probably could qualify no matter who you are, but that is the way the law reads in terms of who can take those distributions. So no matter, like I said, what your age is, if you want to take that distribution from your retirement plans, you're exempt from the 10% penalty. So normally, if you're under 59 and a half years of age and you take a distribution from a retirement plan or an IRA, you have a 10% penalty on top of any potential tax consequences, federal and state. So that 10% penalty, it does not apply to any distributions in 2020 as a coronavirus-related distribution. Also, not subject to mandatory withholding. So a lot of times, or most of the time, when you take a distribution from a 401k or an employer plan, they don't know exactly what you're doing with it. Maybe you're going to roll it over, maybe you're not. But if you take a direct distribution, they typically will have a 20% mandatory withholding. But within the coronavirus-related distributions, there is no mandatory withholding from employer plans. All right, so now in terms of the logistics and how you can really, take advantage of this is, one, you have to qualify, for the type of distribution in general, and then you have an option. So one is that you have the ability to roll that back into that employer plan or that IRA within 3 years of the date of the distribution. So that can be made, it's very specific. It says that can be made in a one-time contribution back into your retirement plan, or it can be made in multiple contributions over time back into your retirement plan. But that would then effectively, erase any tax liability, and it would be a full, what they refer to as roll back into the account. So you do have a full 3 years, and the way it's written is it is 3 years from the date of the distribution, not the calendar year. So again, if I took it today, being April 28th of 2020, I would have, until April 28th of the third year out. Now, if you don't roll it back, you also have some flexibility in how you end up paying the taxes. So the default is that it's going to be spread out over 3 years. So it would be 2020, 2021, 2022. I have read some to where it actually ends up being over the next 3 years, but, I do believe that's the way that it's going to be reported. But bottom line, you can have it spread out over 3 years, or, especially for someone that was, drastically impacted and really needs this money, if 2020 is going to be a low income year, well, then it might make sense to actually have that reported 100% in 2020. So that is an additional election that your tax preparer or yourself, if you're doing your own taxes, would have to make. But that is the option. So if I'm not going to pay it back, the good news is I can at least defer the tax liability, have it spread out over a few years. If this is a really low income year, I could pay all the tax in 2020 if I choose to. The good news for those that are under 59 and a half is that you still aren't going to have the 10% penalty. So that is, a big benefit. But if you need the money now and, things change and you're able to repay that, within that 3-year period, then you've erased any tax liability. So, now a lot of, what I'm still reading and, more information will continue to come out is exactly how this is going to be reported on your tax return. So there's not 100% guidance there of exactly what it's going to look like. But if, for example, you aren't able to pay it, or if your intent is to roll it all back in, but you aren't able to do that, then you'll probably need to file an amendment, after the fact to make sure, an amended tax return to make sure that you then report that income, or, I've read some that the default might be that it's taxable until then you've rolled everything back into the retirement plan. Then you would amend your return to show that you did roll it back in, therefore making it not taxable, and then you would get a refund for any tax paid. So, really a lot of this is something that we'll, all be continuing to look at, and obviously tax preparers, CPAs, enrolled agents, will continue to look at all this, and, later in the year, early next year, then we'll have 100% guidance on exactly how that's going to happen. But, this is all still relatively new, but those are the options. All right. The other thing, and in a second we're going to get into, or a few minutes, we're going to get into some strategy, now to really take advantage of some of this as an opportunity. But the big one for a lot of people is that required minimum distributions have been waived for 2020. So for those of you that aren't aware, we do have a required minimum distribution on our tax-deferred retirement accounts. So 401ks, IRAs, 403bs, TSPs, and the like. So at age 72, so this was actually just changed from last year. It used to be age 70 and a half. At age 70 and a half, now age 72, not part of the CARES Act, but they just kicked the can a couple of years. You do have to start withdrawing your retirement plans. The idea there being that you've put this money in tax deferred, you've allowed it to grow tax deferred for many, many years. Well, at some point, the IRS is going to want to receive some payment or some taxes on that. And so even if you don't need the money, they do then require that you start taking money out at age 72. Well, 2020, they've done away with that. So whether this was the first year you were supposed to take required distributions, or you've been taking required distributions, they are no longer required for 2020, and that does include all employer plans. Another interesting part of this is if 2020, well, let me put it this way. So the first year that you take a required distribution, you actually have the option to defer that first year required distribution into the following year. The only time is just on the front end when you take your first required distribution. So what's interesting is if in 2019 you were required to take a required minimum distribution and you didn't, you decided to defer that into 2020, then actually that one and your 2020 required distribution have been waived. So whether it be last year's, this year's, if you did end up deferring it, all required distributions have been waived for 2020. And that applies to both my own individual retirement plans, but also if I had an inherited IRA or an inherited retirement account, those have also been waived. So there are no required minimum distributions for 2020, which will definitely open up some opportunities, for planning, which we'll get into in a second. Now, one other note is if I have a stretch IRA, so if I inherited an IRA and I wasn't the direct beneficiary, let's say it was left to a trust, or if it was just left to an estate and it needed to be paid out within a 5-year period, this year basically extends it by one additional year. So it essentially makes it a 6-year rule in terms of taking a full distribution. So this just applies though to stretch IRAs, and so it basically adds one more year on that 5-year rule if there was no designated beneficiary on a retirement plan. So what if I already took it? So this is an interesting, if you haven't taken it, it's great. I think there's, it's a lot easier, right? You can do some great planning around, okay, well, this year normally I have to take a required distribution. Maybe it's a pretty substantial amount. This year I don't have to, so that might keep me in a lower tax bracket and open up some other tax planning opportunities. But what if I already took it? So, some people will either take it over time on a monthly basis, some maybe, every year, January 5th, it's the first few business days of the year, I take my required distribution. Well, that adds a little more complexity, but there are a few different options. So There's always a 60-day rollover. So this is why I referenced earlier in the year where this might not be an option. But if it is within the last 60 days, you can always roll those dollars right back into your retirement plan. So if I took my required distribution, let's say a month ago, and now I'm really digging into this and learning more about it, I can just roll that money back in. Now, one note though, with 60-day rollovers is you are only allowed to do a rollover once every 12 months. So if you have already done a 60-day rollover within the last 12 months, then you wouldn't be eligible to do another 60-day rollover. But if you haven't, then that would be one option to undo the tax consequences or undo that income. Another one would be if you do qualify, or if you can justify that you have been affected by the COVID-19 situation financially, then you could always call that a COVID or a coronavirus related distribution. So if I did take my required distribution January 5th of this year, and I'm past that 60-day rollover period, but I really do want to roll that money back, as long as you can justify that you have been affected in a way by the COVID-19 situation, then that would qualify as a coronavirus related distribution. You don't have to pay it back right away if you're categorizing it that way. You do have the 3 years to end up paying that back if you choose to, or you could spread the taxes out. But if you are trying to undo your required distribution and just roll that money back in, you would just, again, this is all going to come down to how you report it on your tax return. Call that a coronavirus related distribution that you took earlier in the year. Again, even if it was in January before, a lot of this first came out. But you would call it a coronavirus related distribution, roll it back in, and especially if you do it this year and it all falls on one tax return, no matter how they end up having you report it, that is going to keep it pretty clean. You took the distribution this year, you paid it back this year. That's going to be a lot more straightforward when taxes are prepared. Now, the one option or the one thing to point out, though, is that's just on my own personal plans or my spouse's plan. If, I inherited my spouse's IRA, let's say, but it is not available for inherited IRAs. So again, RMDs or required distributions for inherited or beneficiary IRAs have been waived for 2020. But if I have already taken my inherited IRA distribution, then I'm not eligible to undo that, unfortunately. And at least based on what I'm seeing, there's really no way around that. But, again, you have a few more options if it's your own personal required minimum distribution. All right, so let me do this. I'm going to now, jump in. Let's take a look. I want to see how we are on time. And like I said, I am going to keep some time for some questions. But let me stop my share real quick. And I want to jump into some strategy. So now, for those of you, let's see here. Bear with me for a sec. All right. Now, for those of you that are clients, you may have seen something similar before, at least in the way for a long time that I've illustrated some topics when it comes to tax planning is, kind of drawing it out. It at least helps me put things in perspective and also, allow me to explain a few different topics. So all right. So this is a concept called tax diversification. So if I kind of draw it out like this, and I'm leaving some room because there's some other things I want to draw, but I've drawn this out many times, but there's really 3 different pools you can have your money in, and each of them are taxed very differently. And so there's tax-free accounts. For today's purposes, we're really talking about Roth IRAs. And as you saw on the slide, when I go back to the slides, it'll explain exactly like what a Roth IRA is, and we'll talk about Roth conversions. But a Roth IRA, the good news there is that any future growth or income, you pay 0% in tax. Now, there's only a couple different ways to get money into a Roth IRA, and we'll go into that, but tax-free accounts. Then there's tax deferred. So this would be 401ks. This would be traditional IRAs, 403bs, TSPs, all types of tax deferred employer-sponsored plans. Well, any distributions I ever take from there, I'm going to pay ordinary income. So whatever my tax rate is at the time. And then taxable, this would really be anything outside the shell of a retirement account. So what I referred to, or not what I refer to, but what's referred to as non-qualified, a non-retirement account. Now that could be really a lot of things, but that could be real estate, that could be stocks, bonds, mutual funds, again, anything outside the shell of a retirement account, where as long as I hold those assets for more than a year and they have gains, well, the good news is there, I get beneficial tax treatment. 15% for most people, can be as low as 0%, can be as high as 20%, but 15% long-term capital gains is where I would say most people fall. But for everyone, regardless of what tax bracket they're in, and I'll get into tax brackets in a second, your taxable accounts or your non-retirement accounts, long-term capital gains, no matter what, are at a lower rate than whatever your ordinary income tax bracket is. So whether capital gains are at 0, 15, or 20, for everyone that will be lower than whatever their ordinary income bracket is. And so a lot of planning that I discuss with people is, okay, well, let's make sure that you have good tax diversification so that you can get a lot more control over your taxes in retirement, especially when it comes to start drawing money from your retirement plans or your non-retirement plans. Unfortunately, though, there's not a lot of control over these types of plans, your tax deferred, your IRAs, your 401ks. I mean, the good news is, and why we've all contributed to them, is as you put money into those plans, you get a tax deduction, or it's pre-tax money. It's right off the top. So I'm able to defer that. I get the tax benefit on the front end. But then, like I was just mentioning, on the way out, we have to be aware that there is ordinary income taxes when I start drawing that money out. Then, even if I don't need the money, at some point, there's going to be a required minimum distribution. So the RMDs that we were talking about. So that's when I'm going to be forced to start pulling money out now at age 72. Or there's also something called IRD, income in respect to decedent. So even if I don't pull the money out and pay the taxes, when I pass that on to my heirs or the next generation, they end up paying taxes. So there is no way around that. Now, I guess in a perfect world, we would have all of our money just in a Roth IRA and have everything completely tax-free. But like I mentioned, and we're not going to fully go through everything here, but I mean, one way, if you're still working and you have earned income, now there are income limitations, but people, if you're over 50, you can put in $7,000 into a Roth IRA. If you're under 50, you can put $6,000 into a Roth IRA. That would just be taking cash, putting it into a Roth IRA, and then the good news there, I don't get any tax benefit going in, but then all the future growth is completely tax-free. So that would be the benefit. So just, I guess, if we compare and contrast, like tax-deferred plans and 401ks, I get the tax benefit going in, but then on the way out, I end up paying the taxes. In a Roth IRA, I don't get any tax benefit going in, but then, let's say I put in $7,000 and over a period of time that grows to $15,000, I can pull the full $15,000 out and pay no taxes on that. So that's the difference between the two. The other way, though, to get money into a Roth, and now this is going to tie some of the CARES Act into this, is by looking at taking money from a traditional IRA or 401k tax deferred type plan and moving it into a Roth IRA by doing a Roth conversion. Now, of course, there's a downfall in doing that, and the downfall is by moving money from my IRA, my traditional IRA, into a Roth IRA, I am going to pay the taxes in between. Like I said, there's no way around the taxes in these tax deferred plans. So, when I move money, and it's not all or nothing, I can move, small amounts, large amounts, it's unlimited. There is no limit on how much you can move from a traditional IRA to a Roth IRA, but you want to be conscious of what tax bracket you're in. So even though there's no IRS mandated limit, I've always worded it that there should be a self-imposed limit, right, based on what tax bracket you're in. But normally, if I'm especially taking required minimum distributions, I've already put myself maybe into a higher tax bracket, or I'm deeper into the tax bracket that I'm in because of those required distributions. So if this is a year where I'm either able to undo the required distribution if I've already taken it, or if I'm just not going to take it all together and I haven't done so already, well, that might open up some additional room for you to take dollars from here and roll it or convert it to a Roth IRA. Now, how you decide, and that is based on, a few things, but really what tax bracket you're in. I would say, and I teach a full retirement planning class where we really dig deep on a lot of this, normally at all the local colleges here in San Diego. A lot of those, or all of those now are virtual classes, but, I get a lot deeper into this, but really, where it's hard to kind of wrap our minds around it is, okay, well, why would I want to move money from a traditional IRA where all the growth is tax deferred, I don't need to pay taxes on it, into a Roth IRA where I'm going to accelerate those taxes? Well, it's hard to do that, right? But at the same time, I think where you need to start is understanding that, okay, those taxes are going to be due at some point anyway, whether it's me, whether it's my children, whether it's my nieces, nephews, whoever my heirs might be. So there is no way around that. And I think where a lot of us come from as well is believing that, okay, well, in retirement, I'm going to be in a much lower tax bracket. So what I'm going to do is continue to put money into my 401k, tax deferred. Then when I start drawing that out, yes, even though it's going to be treated as ordinary income, I'm going to be in a much lower tax bracket. And that's not always the case. And I would say, especially for people that have done a good job of saving, a lot of times, or most of the time, people are in the same tax bracket as while they were working, or some, potentially even in a higher tax bracket than while they were working. And why that is, like if I just give a, hopefully a simple example, I mean, here are our current tax rates. So there's 7 of them, and they go up from here. The highest one ends up then going up to 37%, but I'll use some of these lower ones as an example. Now, to determine what tax bracket you're in, though, that's going to fall on your tax return under taxable income. So worth clarifying, if I have $100,000 of income, before like itemized deductions or standard deduction, that's not the number that tells me what tax bracket I'm in. It's my adjusted gross income, taking away any, itemized deductions, standard deductions, whatever my taxable income is, which is now line 11 on the 2019 tax returns. It was line 10 on the 2018 tax returns. That line item, of taxable income, let's assume is $70,000 in my example. Well, as a married couple, $70,000 of taxable income would put me here in the 12% tax bracket, where, and I'm just rounding up, the top of the 12% bracket for a married couple is close to $80,000. Now, if I'm a single taxpayer, $70,000 of taxable income actually would put me up here in the 22% tax bracket. But, without going through all the different variations of that, it's just, it's the taxable income that determines what tax bracket you're in. And it's so important to understand that number now, whether I'm retired or I'm working, but then also throughout retirement or in retirement, if I'm still working, what tax bracket am I going to be in? So, sometimes, someone might say, like, let me actually do this, that I'm going to be, right now I'm making $100,000 a year. I'm only going to have Social Security in retirement. So obviously I'm going to be in a much lower tax bracket. Well, the key is how much you spend. And this is where we really get into planning. You need to understand, what's coming in, what's going out. If I'm used to living off of $100,000 a year because that's what I've been making, well, if I'm only going to have Social Security, and let's assume that puts me down here, at $25,000 of income, but I've been used to, and I know I'm just kind of making up a hypothetical situation, but I've been used to spending $100,000 a year. Well, if you just lived off of Social Security, and maybe normally I was in the 22% tax bracket, well, if you just had Social Security, yeah, you would actually pay no taxes, or you'd be in the lowest bracket. But the question is, okay, well, if that's 25,000, but I've been used to living off of 100,000, where is that additional $75,000 coming from? And if the rest of that money to supplement my income is all coming from over here in my tax deferred retirement plans, well, that then is all going to be treated like regular income. And that's going to push me all the way back up into, let's say, that 22% tax bracket. So that's before you ever consider doing any Roth conversions, because Roth conversions by no means are for everyone. If I'm really low in a bracket, and it's likely that I'll be there for a long period of time or throughout retirement, might not make sense to, to do a Roth conversion. If I am in a higher bracket now than I'm going to be out in retirement, well then, might not make sense to do a Roth conversion. But, I think you want to go through that exercise no matter what of knowing, okay, what tax bracket am I in now? What tax bracket am I going to be at in the future? And if you find that you're in either the same bracket that you're going to be at, or of course, if you're going to be in a higher tax bracket, that's where it could make sense to shift money from a tax-deferred retirement plan into a Roth IRA. If I was to convert, just making up an example, if I maximized in this example here the 12% tax bracket, Well, I'm going to pay taxes on that, right? That's the bad news, right? I'm going to pay federal taxes. I'm going to pay state taxes on that. So you want to be conscious of that. Ideally, you want to pay for those taxes with dollars outside of a retirement plan, just because if there's a cost to get money up into a Roth IRA, well, then I'd rather have the most that I can growing than tax-free in the Roth. But you bite the bullet, you pay extra taxes now, and then if I was to convert, let's just use an example, $50,000 into a Roth, well, then that 50 grows to 100, whether it's for my own lifetime, whether it's for my heirs, then that's completely tax-free, and there are no required distributions on a Roth IRA. Now, unless it's an inherited Roth IRA, but we'll touch on that. So with that being said, and I know I went through a lot of that fairly quick, if it makes sense for you, because I think this is the first thing to look at, is does a Roth conversion even make sense? Am I going to be in the same bracket throughout retirement? Even if I'm going to be in the same bracket, that still might mean that I want to do a Roth conversion, because yes, I'm biting the bullet, I'm paying more taxes than I need to now. Even if I assume I'm going to be in the same bracket in the future, the benefit is that then all the growth is completely tax-free. So it needs to make sense on the front end. But where the opportunity is, especially in 2020, is if, normally, let's say, for example, I'm taking a $20, $30, $50,000 required minimum distribution, and that's fully maximized. And I know this is getting a little sloppy. I'll clean it up. Actually, if it's already getting me really close, let's assume to the top of the 22% tax bracket there. I never had really any room. I've always felt like I'm going to be in the 22% bracket. That required distribution has eaten up a lot of that in addition to my other fixed income. Well, now getting rid of that required minimum distribution, you might have more room in my example, that 22% tax bracket to do Roth conversions. So this might be one critical year where if Roth conversions, maybe haven't made sense because you're right at the top of the bracket because of those required distributions, we do have some reprieve and the fact that they've been waived for 2020. So, it might be a key year to do some tax planning and shift money into a Roth. Now, if I'm already living off of that money and I don't have any other resources, well then, it's probably likely that whether you call it a required distribution or not, that you're just going to take the distribution because you do need money to live off of. But if, let's say, I have, a good amount of cash, or I've got some money in a non-retirement account that I can live off of to supplement my income, well, then this might be a year where instead of taking a $50,000 required distribution, I take that from my cash, I take that from a brokerage account, which is going to have a lot less tax consequences, especially if it's managed, appropriately. A lot less tax consequences there. It gives me a lot more room in the tax bracket that I'm in, and then I can shift that money that I would normally take as a required distribution from an IRA up to a Roth IRA. Might put me back in the same spot, if this makes sense, right? If I've been taking that $50,000 required distribution or whatever that number is, and now I'm shifting it to a Roth, it's still going to be taxable in the same way. But if it's dollars that I didn't necessarily need to live off of, the great news is the fact that now it's in a Roth IRA. Now it's going to grow completely tax-free. So definitely something to look at. But like I said, very important to have Roth conversions make sense in terms of your long-term planning to begin with. But if it does, then it might be appropriate this year to push out your required distribution, not take it because you don't need to, and shift money into a Roth IRA. So the one other thing to note is the fact that, maybe I don't have a Roth IRA, maybe I don't have other monies to live off of, during this time. The fact that we don't have a required distribution also might open up some other opportunities to where, even though capital gains, you have a lot of flexibility before you start paying tax on capital gains. This might be a year where in my taxable account, if I've built up a good amount of money, I've got some good gains. If I don't have that required distribution, if that would push me into a lower tax bracket, or if that would potentially push it to where capital gains are taxed at zero, then it might be a great year to do some gain harvesting, where maybe with that required distribution, you were always paying 15% capital gains, for example, where if you did away with that and you just lived off of your non-retirement account, you could actually keep yourself where capital gains are taxed at 0%. Well, that could be a great opportunity to take some gains off the table. One other thing, though, I wanted to note, because with a call like this over such a short period of time, obviously there's a lot of little nuances and things that you want to look at and make sure you understand all the pros and cons of any of this tax planning. But one that just popped or came to mind as I was walking through Roth conversions is also Medicare premiums. Of course, if you're on Medicare, if you're over 65, there can be income related adjustments. So if your income's too high, for example, your Medicare premium, Medicare Part B premium could start going up. So a Roth conversion, taking money from an IRA to a Roth IRA, that you need to make sure, to be aware of that, because there are no ways to undo Roth conversions. So you also, want to have a good handle on what your income is going to be for 2020 before you shift money from an IRA to a Roth IRA, because, let's say I'm furloughed or I'm laid off, and then all of a sudden I get back to work a month from now and I'm making a lot more than I was before, where now that Roth conversion was too much. Well, again, you can't necessarily undo it. So you want to go through, if you're doing your own taxes, or you have a CPA or an enrolled agent, or a financial advisor, that's doing this, you want to make sure that you're running, tax projections to figure out what the ideal amount is. Even with taking advantage of course, the CARES Act, you want to make sure you're converting the right amount and that it makes sense for you long term. So now, because especially right now, there's so much uncertainty with regard to income, what I've recommended, to some clients is, okay, well, let's say $50,000, that's the right amount that makes sense to convert to a Roth IRA based on at least what we know now, but maybe there's a little bit of uncertainty with regard to my income. Well, maybe you don't convert it all right now. Maybe you convert $25,000, right? For sure, and again, I'm creating a hypothetical scenario where, for sure you can convert $25,000 and stay within the tax bracket that you're targeting. Well, maybe do that now and then continue to monitor, your taxable income throughout the rest of the year, and maybe towards the end of the year, if everything is just like you projected, bump that up to then, the full $50,000. Now, it's going to go beyond this webcast, but what's interesting as well is there are opportunities. And so I guess I'm not going to, it's going to get really convoluted because it's taking advantage of a few different rules, but even getting outside the CARES Act, for those of you that had done Roth conversions in the past, prior to 2018, we were actually able to undo Roth conversions. It was called a recharacterization. So if you did a Roth conversion, you could undo it, no harm, no foul. Well, starting in 2018, that has not been an option. But there's some, fairly highly respected IRA experts that, have looked at different ways to take advantage of the 60-day rollover rule, and then, moving assets in kind in between retirement plans to where, again, if anyone wants to send me an email or have a follow-up as part of this to really dig into it. It's kind of an interesting, concept, and I'm working with a few CPAs just to, confirm everything. But looks like there might be some opportunities to take a distribution from an IRA in kind in terms of actual shares, and then basically get a 60-day look period to see how the market does before you decide to either roll all that money back to the IRA under a 60-day rule to completely eliminate the tax consequences, or potentially then put that into a Roth IRA where you had that 60-day period to look into it. So there's some complexities, so you definitely want to consult a tax professional when it comes to this, but there is some interesting information to take advantage of, all the volatility in the market and looking at that 60-day period to really see how the investments do. But you're dealing with multiple rules. You're dealing with a 60-day rollover rule, the same property rule is what it's called. So you want to be careful there. But a lot of good strategies. And I think when it comes to tax planning right now, the big one is required minimum distributions, and also, even if I've already taken it, being able to take advantage of the coronavirus related distributions and paying that back. But good tax planning, I think, like as a financial advisor, sometimes whether it's friends or family or just new people I meet, it's always about, okay, what's the next best stock I should buy, or what, I heard about an annuity, what are the pros and cons of that? Investments are important. And if I've built up a good amount of money, I want to make sure, or any money, right, I want to make sure that's prudently invested. But, what I guess gets me excited, which I know I'm probably unique compared to, a lot of people, but it is taxes, right? There's there's good tax planning opportunities. Whether I'm in a situation right now in 2020 where I'm not in a great financial situation. I need to take an employer loan, or I need to take a coronavirus-related distribution. That's good. It's just going to open up, some opportunities to be able to access money that you have with limited penalties or tax consequences. But even if I'm in, fairly decent shape or in good shape when it comes to my retirement planning and the assets that I've built up, if I'm over 70 and a half or over 72, being able to defer that required distribution, that can open up quite a bit. So what I'm going to do is, let me stop this screen share real quick. I do want to get into some, and then what would be really helpful before I jump into that is I am going to end up pasting in the chat bar a link for an evaluation form. So whether you're clients of Canter Wealth, or clients of myself, or someone new to interacting or coming with Canter Wealth, it's really beneficial for me, especially as we're doing these virtual webinars, to get feedback. So I will post that link momentarily as I go through the questions. So if you have, it'll probably take a couple of minutes to fill out. I definitely would appreciate that. Any feedback I can get as we're working in this digital world would be super helpful. So let me pull up some questions and see, and again, if you have any questions, feel free to pop them in. So here's a good question, mainly because I get it a lot. When we start talking about Roth IRAs, a Roth IRA, isn't an investment. So the question is, do you recommend any specific Roth IRAs? So like the benefit is, all I was going through was those are all tax shells, right? So a Roth IRA is great because it grows completely tax-free, but that Roth IRA could be held at the bank, if it was all invested in cash, or it could be held at TD Ameritrade or Charles Schwab or Fidelity, American funds. I mean, it could be held anywhere. So it is really important to know that a Roth IRA in and of itself is not an investment. So I can't, and I know I'm adding more onto this question, right? But I can't necessarily recommend a specific Roth IRA. But what's held inside of the Roth IRA is really important. So like one of the examples I gave was, having it at a bank. Now, it's good. I mean, the fact that like a cash account, if I'm holding cash or, CD inside of my Roth IRA, I don't really have any downside risk. It's really safe, but it's also not going to grow a whole lot. And so one of the benefits, or the biggest benefit of a Roth IRA, is that it grows completely tax-free. So I do want to have an investment inside of my Roth IRA that has more growth potential, right? So cash, I mean, again, I'm preserving the downside. I'm not going to lose a lot there, but if it's not going to grow a whole lot, then it kind of waters down the strategy of getting money into a Roth. Now, I also don't want to just roll the dice and take a ton of risk and buy one individual stock inside of my Roth IRA and hope it works out okay, because then you could lose all the money. So you can make great investments, you can make awful investments inside of any type of retirement plan, including a Roth. But to not get too deep into it, but like I like, open brokerage platforms, like a TD Ameritrade, Fidelity, Charles Schwab, where you really have all options to invest in anything. You're not tied to one particular investment or one particular institution. And you want to try, this goes beyond the scope of today, but of my overall portfolio, if I'm going to have higher returning, or at least higher expected returning categories, like just let's say stocks in general, versus bonds, stocks will likely over time outperform bonds, but there's more volatility, there's more risk there. But to keep it simple and more high level, I'd probably want to have more of my stocks inside of my Roth IRA. During times like these where we've had all this volatility, stocks can of course go down, that's the risk, but over time, if that's going to be a higher returning category, then that's probably something I want to put inside of my Roth IRA. So hopefully that answers that question. Let me just read this one. This one's a little long. Well, let me just read it out loud. Taking the RMD from an IRA and then moving it into a Roth IRA. And then the question is, don't I have to have earned income to be able to put into a Roth IRA after I'm retired? So no. So, but there's a couple things there. Is if I'm taking cash and I want to contribute, let's say I'm over 50 and I want to put $7,000 into my Roth IRA, as long as I qualify, I do have to have earned income. So if I'm retired, I don't have any earned income, I am not eligible to take $7,000 from cash and put it directly into a Roth IRA. But regardless of income, and I do not need to have earned income to be able to convert to a Roth IRA. So when I was talking about taking dollars from your traditional IRA and moving it to a Roth IRA, I do not have to have earned income. And actually, with little or no income, that can sometimes be the ideal time to do a Roth conversion, because, I'm going to be in a lower bracket, which means I'm going to pay less in taxes. Retirement accounts are, they do count towards your estate value when it comes to estate taxes or inheritance taxes. So that was one of the questions. So yeah, they are included as an asset. The other question has to do with taking required distribution. So if I have, let's say, an inherited IRA and I have my own IRA and I have required minimum distributions from both, can I take, it from each of them, or can I take it all from one? If it's an inherited IRA and a traditional IRA, no, you do need to take each of those individually. You can't satisfy your required distribution from your inherited IRA from your traditional IRA and vice versa. But if I have multiple IRAs, let's say, I've got an IRA at Vanguard, an IRA at Schwab, I can't, if it's just my own individual IRA, I can actually satisfy all of that from one IRA if I chose to do so. So with it, when it's my own IRAs, that's definitely something that you can do. So one thing as I go through these questions, I am going to just post this. It should be, let me post it real quick for everyone. But this is that evaluation form, so I want to get it on there. So it's pretty easy. I mean, it's just canterwealth.com/Bernier, which is my last name, Bernier. So on that evaluation form, and I'm still going to get through some of these other questions, but just some quick feedback. There's an area you can put stars, I believe, with regard to just kind of your rating of the overall material. I mean, hopefully you got something out of this. I know it's a short period of time, to get through, especially with some of the stimulus and some of the tax planning I got into. It's a lot, right? So if you do have any follow-up questions, obviously feel free, if you're a client of mine, feel free to reach out to me. Anything that's applicable to your own planning, we'll definitely get into. So, listening in on something like this or having a follow-up question, whether it's for myself or one of the other advisors, we'll obviously make sure to get to it, if it is appropriate for you. But if you do have any specific questions, feel free to reach out to your advisor. And then on that evaluation form, you'll also see a spot if you're not a client of Canter Wealth. You'll see a spot that if you want to have a follow-up call to really see how some of this applies to your particular situation, to see if you need a distribution, to see what your best option is, whether it's taking a loan from a plan or coronavirus-related distribution, or looking at waiving or pushing out your RMD and how that's going to, apply to your own planning. So that is something that I'll definitely offer. If anyone, that's not, of course, like I said, anyone that's an existing client, if you have any questions, it's all going to be part of your planning and happy to answer it. But for those of you that aren't an existing client, if you do want to take me up on, taking an hour or two of my time to sit down and see, does this planning make sense for you, answer any specific questions you have, or really just give you an overall, financial checkup with regard to, are you on track, whether you're retired or not retirement, where are you drawing your income from, are you doing that most efficiently, whether it be from an investment standpoint or a tax standpoint. Definitely, help and give you advice on tax planning, whether it's something we talked about today or not, what might apply to you, how can you more efficiently manage your investments from a tax perspective, and then also just give you some feedback on your current investment strategy, and I don't, pull any punches. I'll kind of give you the good, the bad, the ugly. I'm an open book. It's a free process, right? It's a complimentary checkup. So I'll, be honest with you and tell you what you're doing well, what you can improve upon, try to give you as much feedback as I could there. If you have any questions on insurance, estate planning, that would all be part of it. So if you do want to, take me up on that free financial checkup, there is a part on, or a portion of that evaluation form where you can click yes, and either set up a time, or I can reach out to you, set up a time to give you some feedback, and answer any questions that you have. So that evaluation form now is posted, and you'll also get an email if you're not able to get to it right now, but it does just take a couple of minutes if you do have a few minutes. So let me get more into the question. So I'll be respectful of everyone's time. It looks like we've got 5 more minutes, but another Roth IRA question. Am I able to use any of the Roth IRA money for a real estate investment or other investments? The answer is yes. I'm not the biggest fan of having real estate in retirement plans, but the quick answer is yes. You do have to have a special type of retirement plan to hold real estate. It's what's called a self-directed IRA. So there's special institutions that you can set up a self-directed IRA, but that is possible. You can own a business. You have to be really careful. There's self-dealing rules. There's a lot there, but the quick answer is yes. Let's see. All right, under the CARES Act, am I able to draw money from my Roth IRA this and the following tax year? If, how much, and for what needs? Also, was it taking $6,000 that I can add to a Roth IRA this year? So let me hopefully, and if you want to, the person that asked the question, if you want to send a follow-up, if I don't answer this question based on what you're looking for, let me know. But am I able to draw money from my Roth IRA? And the answer is yes. So under the CARES Act, first of all, let's just use an example of if it's a coronavirus related distribution, if I can qualify for that. And again, there's pretty flexible rules there where, I don't think anyone wants to take advantage of it, and we want to do everything above board, but I think it's a pretty flexible provision. So if I'm taking a coronavirus related distribution, I am eligible to do that from my Roth IRA. So that can be from a traditional IRA, a Roth IRA, an employer-sponsored plan. It still has the same limits, but I am able to, do that from a Roth IRA. And, also in terms of paying it back, right? There's no tax consequences if I'm over 59 and a half, from a Roth IRA. But if, hey, I'm just in a tough spot now and I need that money, but I really don't want to keep it out of my Roth IRA too long. I want the tax-free growth over that 3-year period, whether it be in a one-time distribution or not distributions, but a one-time contribution or multiple contributions back, you definitely can do that with a Roth IRA. And you're not limited to the $6,000 or the $7,000 is the second part of that question. So this doesn't specifically apply to the CARES Act, but I can answer it fairly quick. Is my husband and I, let's see, I just lost, scroll down real quick. My husband and I both qualify to receive Social Security benefits, but his is a bigger benefit. Do I qualify to receive his amount instead of mine? So the answer is yes, but it would be after he passes away. Which isn't the most ideal situation of trying to maximize the benefit. But as a spouse, like let's use myself as an example, I'm married. If, my wife, if I was to predecease my wife and my Social Security benefit was a lot higher than hers, she would no longer get her own Social Security benefit, but she would receive 100% of mine as a survivor benefit. But while both spouses are living, you actually are entitled to at least half. So this might not be applicable to this particular question, but, let's say, for example, I didn't make as much throughout the year, so I'm getting $10,000 a year as my Social Security benefit. My husband or wife is getting $30,000 a year. Well, instead of $10,000, which is my own benefit, I'm actually entitled to a spousal benefit, which would be either 100% of mine or 50% of my spouse's, whichever's higher. So if, let's just say my wife was $30,000, I was $10,000 as my own benefit. Instead of $10,000 a year, I would get $15,000 a year, in addition to my wife continuing to get $30,000. So you don't get both, but you are always eligible if you're married to get 100% of your own or 50% of your spouse's. So a lot of information. I had a cup of water here. I didn't really have time to take a sip of water, but I wanted to at least touch on this topic. I think there's a lot of great planning opportunities, even if it's just not having required distributions this year. I know for at least a lot of my clients that's going to come into their planning. So hopefully you got some good information out of this. Please, if you can, whether you want feedback or to have a follow-up with me or not, it would be helpful to get an evaluation form back so we can continue to improve upon these. Maybe next time having a little more time to get a little deeper into some of the strategies would be something that I was thinking. But yeah, any feedback would be appreciated. And again, free of charge if you want to take me up on a complimentary financial checkup to give you some feedback on what planning strategies might be appropriate for you. Happy to do that. So that's part of that evaluation form as well. So, and then again, for anyone of mine or Canter Wealth, feel free to reach out to myself or one of the other advisors if you have any specific questions. But just know that, of course, if any of this applies to you, we'll make sure to address it in one of our upcoming meetings. But hope everyone's doing well. I know hopefully this is kind of a diversion from being stuck at home, for those of you that are kind of struggling through that or struggling through, loss of jobs or income. I know these are tough times, but, sometimes it's easy to just kind of freeze up and not do anything. But, even with lower income, there can be a lot of opportunities that can come from this. So, if something makes sense, my recommendation would be to at least look into it more and see if it makes sense to implement some of the strategies we discussed. But other than that, I hope everyone's doing well, staying safe, and enjoy especially if you're in San Diego. Weather is beautiful. Enjoy the rest of your day and take care.